You and I need to talk right now, because while everyone has been staring at shiny charts and cheering the latest rally, a quiet market has been screaming in the background, and most people didn't even hear it. For weeks, the spotlight has been on precious metals, vault inventories, supply chain bottlenecks, industrial demand, all the drama that makes headlines and moves emotions. But while the crowd was watching one fire, another fuse was burning under the entire financial system. And this fuse is not in New York. It's not in London. It's in Tokyo. Here's the uncomfortable truth. If silver is the canary, Japan's bond market is the oxygen tank. And the gauge just snapped to empty. Before we go any further, I'm John A.G., and I have to ask you for something small but powerful. My analytics show a huge chunk of you watch every video and still haven't subscribed. If you value this kind of breakdown, hit subscribe right now. Now breathe, because the numbers we're about to walk through are not interesting. They are explosive. Japanese government bond yields are ripping higher across the curve. The 10-year, the 20-year, the 30-year, even the 40-year. And that last one, that's where the story gets scary. When a 40-year yield pushes past the kind of level Japan hasn't lived with in decades, it's not a chart pattern. It's a structural shift. And Japan doesn't do structural shifts politely. Japan does them like an earthquake. You might be thinking, okay, yields moved, rates move all the time. If you're in the US, you might even shrug and say, we've seen higher. But Japan is not the US. Japan has spent decades trapped in near zero rate gravity. A whole generation grew up with the idea that interest rates there basically don't matter. That's why this matters to you. Because when the place that anchored global low rates starts drifting, the entire world's cost of money starts moving with it. And that's not theory, that's mechanics. Japan is one of the biggest creditors on the planet. For years and years, money in Japan couldn't earn a return at home, so it flowed outward. It bought foreign bonds, foreign stocks, foreign real estate, foreign everything. Japanese capital became part of the plumbing of global liquidity. So when yields at home surge and suddenly look competitive, something flips. The incentive changes. The money starts coming back. And when that money comes back, it doesn't float home gently. It rips liquidity out of whatever it was supporting. That's what repatriation does. It pulls, it drains, it margin calls. And the worst part? It doesn't ask your portfolio for permission. Think of the world's markets like a giant leveraged bet that has been running for years. Borrow cheap here, invest higher there, pocket the difference, repeat. Over and over, with bigger size, because the system rewarded it. This is the famous carry trade. And one of the biggest engines for that trade has been the yen. Borrow in yen, convert, buy risk assets, easy money. Until it isn't. Because when Japanese rates rise and the yen stops being free, the math changes. Suddenly, borrowing is expensive. Suddenly, hedging costs more. Suddenly, safe trades start bleeding. And when a trade starts bleeding, institutions don't debate it. They unwind it. How do they unwind it? They sell what they own. They sell what's liquid. They sell what's up. That means high-flying stocks. That means crowded ETFs. That means crypto. That means anything that was purchased with leverage. This is how a bond move in Japan becomes volatility in the S&P 500. This is how a yield chart in Tokyo becomes a red day in your retirement account. And here's the piece that most people miss. Japan's debt is enormous. It's not just large. It's one of the largest debt burdens in the developed world when measured against the size of the economy. And when you carry that much debt, you cannot casually tolerate rising rates. Every tiny increase in yield is a gigantic increase in servicing cost. So the question becomes, why would Japan allow yields to rise? That question is where the rabbit hole opens. Because the answer is ugly. Sometimes you don't allow it. Sometimes you lose control of it. Sometimes the market pushes back. Sometimes defending the currency forces the central bank to step away from buying bonds. And when the buyer steps away, the price falls and yields rise. Bond math is brutal. And bond math doesn't care about speeches. When yields rise, bond prices fall. That's not a headline. That's a balance sheet event. Now imagine you're a massive institution inside Japan, a pension, an insurer, a bank. Your safe holdings are domestic bonds. Those bonds drop. Your balance sheet takes a hit. Your liabilities don't care. Pensions still have to pay retirees. Insurers still have to meet obligations. So what do? They raise cash. And how do they raise cash? They sell what still has value. They sell foreign winners. They sell the profitable positions abroad. And that is where the global problem becomes unavoidable. There's a growing expectation that large Japanese institutions could trim massive amounts of overseas holdings, not because they want to, because they have to. This is forced selling. This is not an opinion trade. It's a survival trade. And forced selling is different. Forced selling doesn't wait for a good price. Forced selling hits bids. Forced selling turns dip buyers into exit liquidity. And if you've been conditioned for 15 years to believe every dip is a gift, this is where that habit becomes dangerous. Because if a large, steady seller is unloading into every rally, the market turns into a ceiling with spikes. Every bounce becomes a trap. Every green candle becomes an opportunity for them. And the slow bleed is worse than a crash. A crash is fast. People panic, then the system responds. A slow bleed is psychological torture. It chops, it grinds, it tempts you back in, then it punishes you again. And that's the environment that a repatriation wave can create. Let me ask you a question that I want you to answer in the comments. Do you think most investors are ready for a world where Japan is a net seller of global assets? Because for most of our investing lives, Japan has been a net buyer. That flow has been a tailwind. If the tailwind reverses, what happens to everything priced on cheap liquidity? That includes stocks, that includes bonds, that includes venture, that includes property. And yes, that includes the US Treasury market. Now we have to talk about the part that nobody wants to say out loud. Japan is one of the biggest foreign holders of US government debt. When that relationship shifts, it's not a footnote, it's the foundation. If Japan stops buying, or worse, starts selling in size, who steps in? That's not a rhetorical question. That's the whole game. Because the US issues enormous amounts of debt constantly. It's not occasional, it's structural, and in a normal world you need reliable buyers. But look around the table. Some buyers are smaller, some buyers are reducing exposure, some buyers are shifting into other assets. So if the largest, most consistent foreign buyer steps back, the pressure goes somewhere else. Yields rise. And when yields rise in the US, the economy feels it everywhere. Mortgages, auto loans, corporate refinancing, government interest expense, bank balance sheets. This is the domino line. And Japan's bond curve is near the front. Now, before we go deeper, I want to do something practical for those of you who want more than a YouTube upload schedule. If you want daily updates, quick notes, and my personal analysis that I don't always post publicly, I created a WhatsApp channel. The link is in the description. Join it because I drop instant updates and even quick voice notes there. Okay, back to the moment the crowd will remember. If Japan's bond market is shaking, the world doesn't just watch. The world responds. Here's what the response usually looks like. Global institutions reduce risk, they cut leverage, they shrink positions, they sell what they can to meet margin requirements. This is why a Japan story can become an everything story. And the everything story has a name. It's the global margin call. The phone rings. The broker wants cash. The fund sells what it owns. Prices drop. Volatility rises. More margin is required. More selling happens. That loop is the nightmare. And it's why people who think this is just Japan are missing the plot. But there's another layer that makes this even more intense. Currency. When Japanese institutions sell US assets, they receive dollars. But their obligations at home are in yen. So they convert, they sell dollars, buy yen. This strengthens the yen. And a strengthening yen is the enemy of the carry trade. Because if you borrowed yen to buy risk assets and the yen rises, your debt gets more expensive in your reporting currency, so you unwind faster. You sell faster, you cover faster. And again, the loop tightens. Now, here's the part that should make you sit up. This kind of unwind doesn't just hit one corner of the market. It hits anything tied to liquidity. Tech, high valuation growth, crypto, leveraged real estate, even safe cash-like funds if the underlying bond market becomes unstable. It's not about whether the assets are good. It's about whether they're held with leverage. And the modern system is drenched in leverage. That's why this matters. That's why we're talking about it. And that's why you need to stay to the end, because the final piece connects this to the one thing that tends to survive. Hard assets. Yes, gold and silver. But not in the simplistic way people talk about. Because the real driver here isn't just inflation. It's the policy response. When a sovereign debt problem collides with a fragile global system, central banks face a choice. Let the system break, or print to keep it alive. And history says they print. They may rename it. They may wrap it in new words. They may call it stabilization, liquidity support, yield control, emergency facilities. But the result is the same. More currency, less purchasing power, higher nominal prices for scarce things. And that's where the metal story returns with teeth. Not because metals are trendy. Because when trust in paper assets breaks, capital searches for something without counterparty risk. And that is why you see money rotate into tangible, scarce, real-world assets when liquidity becomes a liability. Now, I'm going to give you a cliffhanger that most people won't like. The market may not crash in one dramatic day. It may bleed. It may grind. It may trap you with hope. And that slow process can be far more damaging than a fast panic because it drains confidence while it drains capital. So if you're waiting for a cinematic one-day collapse to take this seriously, you may already be late. Because the real damage starts before the headline. The real repositioning starts quietly. And then, one day, the public notices, and the exits are crowded, That's why, in the next stretch of this breakdown, we're going to get specific. What assets are most at risk, how the repatriation wave could show up in market behavior, and what signals would tell us the unwind is accelerating. But first, I want you to do two things. One, if you know anyone who keeps saying nothing matters, share this with them. Two, drop a quick comment, literally anything, even our John AG. So the algorithm knows you're here and you want this campaign to win against copycat channels that recycle content without doing the work. Because yes, I'm running a campaign to eliminate copycats, and your engagement is a weapon. Now, let's zoom into the part of this story that makes Wall Street nervous: the overseas equity exposure. Large Japanese institutions hold enormous positions in foreign equities. The size is so big that even a gradual reduction can act like a persistent headwind. And that word gradual matters. Because if someone sells everything at once, the market breaks quickly and policy responds quickly. But if someone sells steadily over months, the market can't fully recover and investors keep buying dips that never become bottoms. This is how a market can spend a long time going nowhere, while silently destroying wealth through opportunity cost and inflation. The sellers use rallies to sell. They let retail buy the hope. They distribute risk to the crowd. That's not conspiracy, that's liquidity. Now you might ask, which areas feel it first? Usually the most liquid, most widely held, most profitable positions, the names everyone owns, the names that sit inside every index, the names that feel untouchable. And this is where I want you to be brutally honest with yourself. Are your holdings crowded? Are you holding what everyone else holds because it feels safe? Or are you holding what's scarce because it actually is? This is the difference between being inside a liquidity bubble and being outside it. And the Japanese shift is about liquidity. Now, there's a second group that gets blindsided in this kind of environment. People who think cash is always safe. If you park money in instruments that rely on short-term debt stability, you are still connected to the bond market. You're not immune, you're just one step removed. If bond volatility spikes and funding markets tighten, even cash-like vehicles can face stress. This is why the phrase counterparty risk matters. And this is why hard assets become attractive. Not as a get-rich-quick trade, as an insurance policy against the system's weakest link, confidence. Now, I promised we'd keep retention high. So here's the question that changes everything. If Japan's bond market forces higher global yields, what happens to the US Treasury auctions? Because auctions are not a vibe. They're a test. Every auction asks, who wants this debt at this price? And if demand weakens, price falls, yield rises. And if yield rises enough, the economy slows hard. So policymakers will do what they always do, intervene. That intervention can stabilize yields, but it does so by injecting liquidity. And injecting liquidity while inflation is still a concern is not a clean solution. It's a trade-off. And trade-offs create winners and losers. The losers are people holding currency and long-duration paper. The winners are people holding scarce things. Now, if you want a side channel that focuses specifically on silver-related success stories, the real journeys, what worked, what didn't, and how people actually made money, there's a link in the description. Give that channel a quick subscribe too, because it's a different angle and it's genuinely motivating. All right, let's talk about the buyer of last resort problem, because this is where the story stops being academic. If foreign demand weakens and domestic demand can't absorb the issuance at current prices, the central bank becomes the buyer. That's what monetization is. It's not a word game, it's a mechanism. And monetization is one of the most powerful forces in markets because it shifts the value of the unit of account. If the unit is being diluted, everything denominated in it changes in nominal terms. That includes metals, that includes energy, that includes food, that includes real estate, but not evenly. Some things respond faster. Some things respond violently. And silver, because of its smaller market size and dual industrial monetary role, often responds with more volatility than gold. So if you're wondering why metals can spike even while risk assets wobble, it's because smart money isn't buying metals for the same reason they buy stocks. They're buying for protection. They're buying for the policy response. They're buying for the moment when the public realizes the system has to choose between pain now or pain later. And the system usually chooses pain later. That is, it chooses printing. Now, I want to add another engagement moment. What do you think is more likely? Central banks let markets clear naturally, or they step in and print to prevent a crash? Drop your answer below, because I want to see where your head is. Okay, now we need to talk timeline, because people always ask, is this immediate? Here's the honest answer. The first phase can look like normal volatility, a bad week, a sharp move, then a bounce. And everyone says, see, it's fine. But underneath, the flow continues. Repatriation doesn't need headlines, it needs math. If yields at home pay more, if hedging costs rise, if domestic bond losses appear, the incentive remains, so the selling can persist. And persistence is what breaks narratives. The narrative says, buy the dip. The flow says the dip is being sold into, and when narratives break, people scramble. Now you might be sitting there thinking, so what do I do? I'm not your financial advisor, but I can lay out the framework. First, identify where you are exposed to duration and leverage. Long duration bonds are sensitive to yield spikes. High valuation growth stocks are sensitive to higher discount rates. Leverage positions are sensitive to volatility. Second, think in terms of counterparty. If you own something that depends on someone else's promise, you are exposed to their solvency. Third, think in terms of scarcity. In a world where policy responses involve creating more currency, scarce assets tend to protect purchasing power. Now we're going to tighten the screws. Because the most dangerous part of this story is what happens when the US has to refinance more debt at higher rates. Interest expense rises, deficits expand, more issuance is required. And if the market demands higher yields to absorb that issuance, it becomes a loop, a fiscal loop. This is how debt dynamics become self-reinforcing. And this is why the bond market is not boring. The bond market is the engine room. And Japan just threw a wrench into the global engine. Now, there's one more community note I want to drop, because it matters. If you're successful, if you've built a business, made a smart investment, or turned your situation around, share one line in the comments about what worked. People underestimate how much that helps others. Also, quick heads up. By the time you're watching this, there's a members-only video already published. If you join the membership, you'll get a single video that bundles the latest updates and deeper analysis, and it shows me who's really following the work. Now, back to the pressure points. If Japan continues to normalize rates, the rest of the world doesn't stay unchanged. Because markets are linked. Risk parity, cross-border holdings, derivative hedges, funding costs, this is a system, and systems react. Which brings us to the final question. What does the end game look like? The end game is not necessarily a dramatic default headline. It can be softer. It can be inflation, it can be financial repression, it can be yields capped by policy while prices rise. In that environment, nominal asset prices can rise while real purchasing power falls. And that's why people who focus only on price charts miss the deeper truth. The real fight is over purchasing power, and Japan's shift is accelerating that fight. So here's the takeaway, and I want you to feel it. When the world's historic low-rate anchor starts floating upward, global leverage starts to unwind. When global leverage unwinds, liquidity drains from risk assets. When liquidity drains, policymakers step in. When policymakers step in, the unit of account gets diluted. And when the unit gets diluted, scarce assets reprice. That's the chain. That's the story. And we are watching the early links form in real time. So don't treat Japan like a faraway curiosity. Treat it like the first domino. Because if the domino line is real, the next pieces fall faster than people expect. And if you want to keep up with the next moves, subscribe, join the WhatsApp channel in the description, and check the members-only video for the full bundle of updates. One last thing. Support the campaign against copycats by dropping a comment, even one word, and sharing this video. It tells the algorithm this is original work worth pushing. Now, keep your eyes on yields, keep your eyes on the yen, and keep your eyes on liquidity. Because the moment the market realizes Japan isn't a buyer anymore, that's when the real repricing begins. And you don't want to be the last person to notice. Now, let's slow down for a minute and make sure everyone understands why a move in yields is not just an interest rate thing. A bond is a promise. You lend money, you get paid back later, and along the way you collect interest. Simple. But the price of that promise changes every day. And the price changes for one reason. What return does the market demand right now? If the market demands a higher return, the old bond that pays a lower coupon becomes less attractive. So its price must drop until the effective return matches the new market yield. That is why a jump in yields is a drop in bond prices. So when you hear yields are up, translate it instantly. Someone's bond portfolio is down. And in Japan, those portfolios are massive. They're held by the institutions that underpin the entire domestic financial system. Pension funds, insurers, banks, mega funds that were built for a world where yields were pinned near the floor, a world where the central bank was always there as the bid. That's the other crucial part. For a long time, the central bank was not just a participant, it was the dominant buyer. It acted like a permanent stabilizer, absorbing supply, smoothing out volatility, and forcing rates lower. That kind of policy creates a certain behavior. It teaches the market that risk is limited. It encourages leverage. It creates comfort trades. But when the policy shifts, the comfort disappears, and the leverage is suddenly exposed. So if the bond market in Japan is repricing, you're not watching a normal adjustment. You're watching a system recalibrate. Now, a lot of people want to blame foreign investors or speculators or hedge funds. Sometimes those groups matter. But the reality is that sovereign bond markets are creatures of credibility. If the market believes the central bank has unlimited power to control yields and unlimited tolerance for balance sheet expansion, yields can be kept low for longer than most people think. But the moment the market starts doubting that tolerance, the moment the currency becomes the constraint, the moment inflation expectations become the pressure, that's when the bond vigilantes wake up. And if you've never lived through a bond vigilante era, you need to understand something. It's not subtle. It's not polite. It's an auction-by-auction referendum on policy. Now, this is the point where I want you to imagine two doors in front of Japan's policymakers. Behind door one is keep buying bonds, keep suppressing yields, keep monetizing. Behind door two is stop buying bonds, let yields rise, regain currency credibility. Neither door is painless. Door one risks currency weakness and inflation. Door two risks a bond crash and fiscal strain. And here's the trap. Once you have too much debt, every door hurts. That's what excessive leverage does. It turns choices into emergencies. So if Japan chooses the currency door, less bond buying, the bond market has to find a new price. And the new price means higher yields. And higher yields mean lower bond prices. And lower bond prices mean balance sheet holes. Now you see the chain. And because the chain is mechanical, it can spread. Let's connect it to the carry trade with more clarity. The carry trade is basically a rent-a-currency business. You borrow in a cheap currency, pay almost nothing, convert to another currency, and buy assets that earn more. Even if the asset doesn't pay yield, you're betting that the asset rises, and you'll make money in the spread plus the appreciation. But this trade has two hidden risks: currency moves and funding costs. If the cheap currency strengthens, your debt becomes more expensive. If the funding rate rises, your carry shrinks or turns negative. If both happen, it becomes a fire. And in a fire, leveraged investors don't calmly adjust. They liquidate. They don't sell because they want to. They sell because their prime broker forces them to. That's why this kind of episode can look irrational if you only watch individual company fundamentals. The selling is not a judgment on the company. It's a judgment on the funding environment. Now, let's talk about what you should watch, because this is where you get an edge. First, watch the yen, not because you care about vacations or imported cars, because the yen is the pressure gauge for the carry trade. A strengthening yen is a sign that repatriation is intensifying and that leveraged bets funded in yen are under stress. Second, watch cross-currency basis and hedging costs. Most retail investors never look at this, but institutions live in it. If hedging costs spike, foreign assets become less attractive to Japanese buyers, and repatriation becomes more likely. Third, watch U.S. Treasury auction metrics, bid-to-cover ratios, indirect bidder participation, tail sizes. You don't need to be a bond nerd. You just need to spot the trend. If auctions start showing weaker demand, yields can drift up faster than headlines admit. Fourth, watch credit spreads. When credit spreads widen, it's a sign the market is demanding more compensation for risk, which often happens when liquidity is being withdrawn. Now you might be thinking, but markets always find a buyer. Sometimes they do, sometimes they don't, sometimes the buyer becomes policy. And that's where the Federal Reserve enters the story like a character you hoped wouldn't show up. Because the Fed has the ultimate power. It can create dollars, it can buy assets, it can calm markets. But it can't do that without consequences. Every time the Fed steps in, it changes incentives. And if it steps in while inflation is still in the background, the market starts asking a dangerous question. What is a dollar worth? Now, this is also where the metals narrative becomes a lot more than a hobby. When bond markets are unstable, people look for assets that do not depend on someone's promise. A bond is a promise. A bank deposit is a promise. A money market fund is a promise wrapped in paperwork. But physical metals are not a promise. They are the asset. And that's why, in periods of monetary uncertainty, they become magnets. Not for get-rich reasons, for don't-get-wiped-out reasons. Let me put it another way. In a world where the policy response to debt stress is currency creation, owning the thing that cannot be created becomes a form of defense. Now, I want to address something you might be worried about. What if metals dip too? Yes, they can. They can dip in the early phase of a liquidation because everything gets sold to raise cash. But that dip is not the end of the story. That dip is often the setup for the policy response. And the policy response is what changes the game. So don't confuse a short-term forced sale dip with a long-term trend. Now, we also need to talk about the psychological weapon in this environment: narratives. When markets are fragile, narratives become louder. You'll hear, it's contained. You'll hear, it's already priced in. You'll hear, this time is different. You'll hear, soft landing. These phrases are comforting. They are designed to keep you calm. But the market doesn't care about comfort. The market cares about flows. If the flow is out, the price falls. If the flow is in, the price rises. So if you want to survive this kind of cycle, stop asking, what do I believe? Start asking what is the money doing? Now I'm going to do a quick viewer question segment because I've been getting the same 2 questions nonstop. First question, if Japan pulls money back home, does that automatically mean the US stock market crashes? Not automatically in one day. What it means is the market faces a steady seller, and a steady seller changes the character of rallies. You can still see bounces, you can still see weeks of strength, but the ceiling gets lower, the market becomes choppy, and the risk of sudden air pockets grows because liquidity thins out underneath. Second question, if the Fed prints, won't that just push stocks up again like it did before? It can, but it depends on the sequence. In the early stages, liquidity can drain faster than the Fed can respond, especially if the shock is global and funding markets tighten. Later, if policy becomes aggressive, nominal asset prices can rise. But you may still lose in real terms if inflation outruns your returns. That's why the right question is not, will stocks go up? The right question is, will my purchasing power go up? Now, we need to address the elephant that sits in the corner of every serious conversation, the US dollar. If global investors sell US assets and convert to their home currencies, the dollar can weaken. But if global investors sell risk assets and rush to dollars for safety in the middle of a panic, the dollar can strengthen temporarily. This is why you can see whiplash. This is why charts can confuse people. The dollar can spike in the initial panic and then weaken later when policy turns fully inflationary. So if you're trying to time this like a day trader, you may get chopped to pieces. The better move is to position for the bigger cycle. Now let's talk about what happens to everyday life if yields rise and stay high. Housing becomes less affordable because mortgages follow. Businesses invest less because borrowing costs rise. Governments pay more interest, which crowds out other spending. Consumers feel it through credit cards, car loans, and pricing. And when consumers feel pressure, the economy slows. That's the macro chain. Now, what is the typical political response to slowing growth and rising debt costs? More stimulus, more programs, more spending, which often means more borrowing, which brings us right back to the bond market. You can see why this becomes a loop. And loops are dangerous because they don't resolve gently. They resolve when something breaks or when the currency takes the hit. Now, here's the cliffhanger. There's a point where the market realizes the risk-free asset isn't risk-free. Not because the US can't pay in nominal terms, but because paying in diluted currency is a hidden default on purchasing power. And when that realization spreads, the appetite for long-duration bonds collapses. That's when you see the true repricing of everything. That's when you see why hard assets become lifeboats. Now, I want to bring the focus back to your actions. This is not about panic. This is about preparation. Preparation means reducing blind exposure to the most vulnerable parts of the system. Preparation means diversifying away from a single narrative. Preparation means owning assets that can survive different outcomes. And it means staying informed. And that's why I keep telling you, join the WhatsApp channel, because when something breaks, I can drop an update there immediately. Now, let's talk about the scenario that scares central bankers the most. A failed auction, not a weak auction, a failed one. That's when the market says, at this price, we don't want the debt. And if the government still needs funding, the central bank steps in. When the central bank steps in, people start to question the currency. And when people question the currency, they seek alternatives. That's when the metals narrative stops being niche and becomes mainstream. Now, I'm not saying tomorrow is that day. I'm saying the path matters. And Japan's bond market is one of the biggest signposts on that path. So if you're the kind of person who wants to be early, not late, you watch signposts, you don't wait for the billboard. Because by the time the billboard arrives, the price has already moved. Now, before we close, let's tighten the message into a simple framework you can remember. Step 1, recognize the shift. Japan's rates moving is not just Japan. It's a global funding shift. Step 2, watch the flows. Yen strength, hedging costs, auction demand, credit spreads. Step 3, anticipate the response. If stress grows, central banks respond with liquidity. Step 4, protect purchasing power. Diversify into scarce assets, reduce counterparty risk, avoid being the last buyer in a crowded exit. And through all of this, keep your head clear. Markets are loud, but the math is louder. Now, I'm going to end with one final question that I want you to answer below. If the biggest source of cheap money in the world is no longer cheap, what happens to the everything that was priced off cheap money? Answer that, and you'll understand why this story is bigger than a bond chart. Subscribe if you haven't. Join the WhatsApp channel. Check the members-only video already up, and drop that comment to support the campaign. Because the next wave of this story won't announce itself with a siren. It will arrive like a tide, quiet at first, then unstoppable. And one more thing before you click away, because this is where most people miss the opportunity. The first phase of a big shift always feels manageable. A little volatility, a few scary headlines, then a relief rally, and everyone relaxes. But the real signal isn't the headline. It's the behavior. It's the market struggling to recover. It's the rallies getting sold faster. It's the dips getting deeper. It's the sense that something is leaning on the price. If you start seeing that pattern, don't argue with it. Respect it. Because when institutions are repositioning, they don't tweet about it. They don't announce it. They just do it quietly, consistently. And then one morning, the public wakes up to a new world. So keep your eyes on the yen, keep your eyes on long yields, and keep your eyes on liquidity indicators like a hawk. And if you want me to cover specific tickers, specific sectors, or specific safe haven plays as this unfolds, tell me in the comments what you're watching. Are you more worried about stocks, bonds, or the dollar itself? And are you positioned like a tourist or like someone who knows the storm is real? Hit subscribe, join the WhatsApp link, and check the members only update, because the next break won't wait for anyone. Stay sharp, stay ready.